Hi, this is Nick Seagren from Vision Finance with another 2-minute quick tip. Today's quick tip is for first homeowner buyers and is on the topic of mortgage insurance. So as a first homeowner buyer, you have two options. The first option is to save up a full 20% deposit plus costs for the new property to avoid mortgage insurance. And the second option is to save up less than a 20% deposit. And obviously you need to save some funds for costs as well, but end up paying mortgage insurance because you're saving less than 20%. Now, what exactly is mortgage insurance? Well, it's a once-off fee that's payable to the lender on the day of settlement, and it's payable when you're borrowing more than 80% of the value of the property. Most importantly, mortgage insurance is a fee that protects the lender and not you as a borrower in any way, shape or form. Okay? So if we have a look at an example, a quick example just to compare the options of paying mortgage insurance or not, if we start off with a couple that are looking to buy a $500,000 property. Now, to avoid the mortgage insurance, they're going to need to save up a 20% deposit of $100,000, and their costs in this case will be around about $25,000. So they need a total deposit of $125,000. Let's say they've got $80,000 currently in their savings account. That includes savings that they've saved to date, plus an inheritance or an early inheritance from their grandparents or a gift from their parents. Now, for them to be able to purchase that $500,000 property, if they were to look, they'd need to add an extra $45,000. So if they started off with their $80,000 and they added $2,500 per month, then it'd take them approximately 18 months to save the extra funds. Okay, now if we contrast this situation to the situation where they would actually pay mortgage insurance, then they could start off with their $80,000 in savings and putting no extra money into the bank, they could actually go and purchase the property now and pay mortgage insurance of around about $8,000. $80,000 would be a big one. No, pay mortgage insurance of around about $8,000. Now, how do those two compare? So why would you bother paying mortgage insurance? Well, if we were to look at the couple that bought the property today, if the property market was creeping along and let's say it increased at about 3% over the next year, then over that period, the property that they'd purchased today would be worth $515,000. Compared to the couple who hadn't actually purchased their property yet, they would have paid their mortgage insurance of $8,000, but they'd still be $7,000 ahead. Now, if the property market went a bit more quickly and it rose at 7%, then their current property would be worth $535,000, so they'd be even further ahead. Of course, property values don't always go up. They can go sideways, and sometimes property values can even go down. So by paying mortgage insurance, it's by no means a guarantee that you'll get into the market and get going in the property market sooner, but for many people who are looking to get into their own home, it is a good way and a good option of getting into their own home sooner and hopefully increasing their equity more quickly by getting into the property market. So that's Nick Seagren from Vision Finance, and if you'd like more information either on mortgage insurance or on how you can get into your first home, please feel free to give us a call on 1300 363 677. Thanks.